This chart shows us corporate profit margins as a percentage of GDP. You can see they've been on a clear uptrend since the early 1980s, culminating in one of the most profitable periods in stock market history that we're experiencing today. One of the reasons for this growth in corporate profit margins is the expansion of free trade and globalism over the last 40 years. In fact, on this chart, we see a clear correlation between rising exports and US corporate profits. As free trade has opened up, American companies have profited from access to cheap labor and manufacturing overseas, and consumers in foreign markets, leading corporate profits higher. Donald Trump's tariffs could put a heavy dent in this trend, as many companies will need to bring back manufacturing to the United States. Of course, this is exactly what tariffs are meant to achieve, but it could come at the cost of lower corporate profits. In aggregate, we believe that tariffs are more likely to lead to shrinking profits for US-based companies, especially those with heavy foreign exposure. But it's hard to say exactly when these tariffs are going to start weighing on corporate profits. Donald Trump has not yet formulated a clear plan for how he's going to implement them. What is certain, however, is that the impact of tariffs have not yet been taken into account by analysts. Wall Street forecasts on S&P 500 earnings are at record highs right now as a result of the US sidestepping a recession and continuing to print strong economic growth. These strong earnings are what have been driving the market higher since 2022. Now, it could be that if Trump does go through with the tariffs, over the duration of the next 4 years, a significant trade war could slow down earnings growth and, in the worst case, completely turn it around. The New York Fed found that firms with ties to China lost $1.7 trillion in market valuation as a result of tariffs during Trump's first term. With tariffs around 4 times larger during his second term, one could speculate that this cost would amount to as much as $5 trillion in market valuations, which equates to about 10% of the total S&P 500 market cap. That's how we think the real impact of tariffs will be felt. In fact, if we look again at corporate profits as a percentage of GDP, we can clearly see that declines in corporate profits tend to precede economic recessions as companies are forced to cut down costs and so potentially laying off employees given the reduced profits. To be clear, we don't think we'll see the impact of tariffs on the stock market immediately. Fundamental forces are still driving the market higher today, but shrinking corporate profit margins could become a problem in the second half of 2025 if these tariffs are implemented now.